Is the money in your bank account safe? Both regulators and central banks have been trying to avoid a full-blown banking crisis, but people are still concerned. So how can we gauge whether our money is safe? Stay tuned to see how you can assess this risk for yourself, and I'll also show you how to reduce it. This video is sponsored by Babbel, an intuitive language learning app. So let's see how safe your money is in the bank in a bit more detail. The big concern at the moment is that we're going to see more bank runs. What is a bank run? Well, it's when everybody tries to take out their money at once. And the problem is that the bank doesn't have your money in the form of cash. It's already invested it in other investments which generate a profit for the bank. So the big assumption that banks operate on is that not everybody will ask for their money back at the same time. And while that assumption works, they're profitable. When that assumption breaks down, the bank can become bankrupt, and it's called a bank run. Now, this is amplified in the age of social media, when if there is a concern, people will start to take out money all at once because the message will get around on Twitter, say, that the bank is going down, and there'll be a big rush to take out their deposits. A recent example was Silicon Valley Bank, and you can see their balance sheet here beside me. What is a balance sheet? Well, it just shows you what assets the bank has. That's the left-hand column, and the assets are used to generate income for the bank and profits. And then the liabilities on the right-hand column are how they funded those assets. Notice that the assets and liabilities are exactly the same size. So let's say you put $1 into Silicon Valley Bank. Here you can see that it would sit in a non-interest bearing demand deposit account. Demand deposit account just means you can take out the money anytime you like without any warning. Now you might think that because that makes up about $81 billion, you can see that beneath me, then you should have $81 billion of cash sitting on the asset side of the balance sheet. Well, there is cash on the balance sheet. You can see cash and cash equivalents make up about $13.8 billion. But what's much more likely is that your $1 was lent out to generate a profit for the bank. So it'll sit somewhere here in the net loans, for example, which make up about $74 billion. But that's why the cash and cash equivalents are only $14 billion, whereas the non-interest bearing demand deposits make up about $81 billion. So if all of these people suddenly say, I want my money back, the bank is just not going to have enough money to give them. It has to sell assets as quickly as it can in order to generate that cash, and that's what triggered the problems at Silicon Valley Bank. The problem was that lots of cash had poured into Silicon Valley Bank from venture capital companies, which went into tech companies, which then deposited it at the bank. Now, as we saw, the money was then converted into assets, income-generating assets. In this case, lots of US treasuries and other types of bond. The problem then was that interest rates increased very rapidly over the last year. And when the interest rates increase, the value of bonds falls. Now, that's not a problem if you can just hold the bond until it matures. But if you have to sell the bond before it matures, then you crystallize a loss. So the problems really started when the tech wreck happened in 2022 and the flood of money that came out of venture capital and into these companies dried up. At the same time, a lot of the companies weren't profitable, so they were going through their cash very rapidly. So the deposits were actually withdrawn to pay the costs of these companies. Plus the inflow of new cash essentially stopped. So Silicon Valley Bank went from a situation where it was flush with deposits to one in which the deposits were shrinking fast. What did it have to do? Well, it had to sell its available for sale securities or its treasuries. And it had to do that before they matured, and it had to crystallize a loss. The next problem was that many of these depositors were tech companies which would chat about this stuff in Telegram groups and on social media. And once the rumor got around that the company was in trouble, everybody pulled out their money at once. And when that started to happen, Silicon Valley Bank failed. So one thing to watch out for is a very large part of the liabilities made up by deposits. In the case of Silicon Valley Bank at the end of 2022, 82% of the way they funded the company was via those deposits. Now later on, we'll also see an important number is the amount of equity held by the company as a proportion of the total assets of the company, which in the case of Silicon Valley Bank was about 7.7%. As it turned out, that wasn't the problem. And just for comparison, here's another bank, the biggest one in America, which is JP Morgan Chase. This is their balance sheet at a comparable time at the end of 2022. Now, deposits with JP Morgan still make up 64% of the liabilities. If everybody pulled their money out of JP Morgan, they would still be in trouble. They could fail. But what's critical is their deposit base is much more varied. It's not just one industry, the tech industry, it's many different industries. So that's something you should be careful of. Is the depositor base just one industry? And does it make up a huge proportion of the balance sheet as it did for Silicon Valley Bank? And you can find this in the company report. So if you wanted to see JP Morgan's balance sheet, you just Google JP Morgan Chase 2022 annual report, PDF, and then you just search inside that document for consolidated balance sheet, and you'll see these numbers. And that's why if you look at tweets from other central banks, particularly regional US banks, you'll see them come out with statements like this, where they're desperate to show that they're not like Silicon Valley Bank. How are they different? Well, firstly, more than 55% of their deposits are insured. As we'll see in a moment, that's really important, but a large proportion of Silicon Valley Bank's deposits weren't insured. So people did consider their capital to be at risk, and if the bank looked like it was going to fail, it was completely rational to try and take out their money as quickly as possible. Western Alliance Bank also says that their unrealized losses, remember those treasuries which lost value when interest rates increased, their losses, their unrealized losses, are only 1 billion. Now, assuming they don't get deposit flight and they have to sell those assets, they'll never have to crystallize that loss. And now we've got a new lending program from the Federal Reserve, which means that Western Alliance Bank can just give those treasuries to the Fed and get money in return. So that risk is greatly reduced. Another thing which Western Alliance Bank has stressed is that they have a very diverse deposit base. Remember that Silicon Valley Bank was very much concentrated in tech. Not so for this bank. Tech companies make up less than 8% of their total deposits, as they say. So the structure of the deposits is an important thing to look out for, and the concentration of the type of deposits is also important. Before we go on with the video, let me quickly mention the sponsor, which is Babbel, the language learning app. Now, I'm going to be going to France later this year with my partner Laura, and I'm going to be in charge of communication, so I really have to brush up my schoolboy French. It's not great. Now, what I've found is that people really appreciate it if you make an effort and try and speak in their language, even if the results aren't perfect. So what I really like about the Babbel app is that it's very conversational in its approach. Rather than just throwing vocabulary at you, it's focused on typical conversations that you'd have in a restaurant or on business. So for example, here's a dialogue between two ladies in an office, and they're planning to go out for a drink after work. And I'm asked to fill in some of the vocabulary if there are gaps in the text. So I picked up fairly quickly what my level of French was, and it suggested lessons which are appropriate. You can also practice speaking with Babbel Live. So if we want to browse the classes which are available today, we could discuss nationalities at 3 o'clock or talk about literature in French. I think that's a great way to throw yourself into it and force yourself to learn as much as possible. Now, as a viewer of PensionCraft, you get a special discount from Babbel where you get 50% off lifetime access to all 14 of the languages which they offer. To learn more about that, just click on the link in the description below. Now let's turn to those deposit guarantees, both for the UK and the United States. This is what that deposit guarantee scheme is called in the UK. It's called the Financial Services Compensation Scheme, or FSCS. And this is a pot of money which is funded by the banks themselves, and it guarantees up to £85,000 per eligible person per bank, building society or credit union. Now, if you have a joint account, of course, it's twice that amount, £170,000. Now, you have to be a little bit careful about the bank because there are often two banks which have the same parent company, and those don't have a separate guarantee. But if you do have more than £85,000, you'd spread it between multiple banks. That way your deposit will always come under the guarantee. Just be careful about the parent entity, and if you want to check that, go to this protection checker, which you can find on the FSCS website. There's also a document you can get from the Bank of England, which has the parent entity and the kind of child entities. So for example, HSBC UK Bank has these subsidiaries, which are other brands covered by the same guarantee. So if you have a bank account with First Direct, that's under the same guarantee as HSBC. The equivalent scheme in the United States is the FDIC, the Federal Deposit Insurance Corporation, and this is actually a branch of the US government. It's one of their agencies. It's the same idea, which is that if a bank fails, this provides a guarantee for your deposit. And the phrase that really means a lot is that the FDIC insurance is backed by the full faith and credit of the United States government. Sometimes you see a little brass plaque in the bank which says just that. But if it comes with an FDIC guarantee, your deposit will be guaranteed up to an amount of $250,000 per depositor, but also per FDIC insured bank. So the same trick will work, which is if you have more than 250k, you can split it amongst multiple banks. But it's also per ownership category. So for example, if you have some trust accounts, those would be treated separately from your deposit accounts. Again, you should check with your bank whether separate accounts have separate guarantees to be absolutely sure. Now, the problem with Silicon Valley Bank was that not enough of the deposits were covered by that guarantee. Some of those tech companies had deposits of billions, so the 250k guarantee was sort of meaningless. And this is one reason why the White House is being pressed to increase that 250k guarantee. And I think that's unlikely to happen because of moral hazard. Banks could just start to take crazy risks because of the FDIC guarantee covering all of their deposits. You've got to have some risk of bank failure to keep the bank management on their toes and keeping risk in check. But who knows, maybe if the crisis gets worse, this FDIC guarantee will be expanded, but at the moment, there's no sign that's going to happen. Another thing to look out for is whether your bank is systemically important. What does that mean? Well, in the previous huge banking crisis in 2008, people were worried that banks would take too much risk and that if that was the case, then the entire banking system could collapse. That's because really large banks had a much bigger impact on the economy if they went down than small banks. So one of the things that the regulators decided to do was draw up a list of how systemically important each bank was, with the largest banks having the greatest footprint being the ones which are most likely to be systemically important. So there's this designation of a GSIB, a globally systemically important bank. And then that's subdivided into different buckets. So the most important bucket in the GSIB category would be a bank like JP Morgan, because it's both large, highly interconnected with other banks and other financial institutions, and it satisfies these other criteria for being GSIB bucket 4. Then in the next bucket, we've got GSIB bucket 3 and so on down to GSIB bucket 0. What does this mean in terms of your bank safety? Well, they have to have much more stringent risk controls if they're considered a GSIB. They also have to pass really strict tests called stress tests in order to ensure that if things go belly up in the economy, they'll survive. Now, I've highlighted 3 of these banks which are in the UK, which are considered GSIBs. That's HSBC, which is a bucket 3 GSIB. We've also got Barclays, which is a GSIB bucket 2, it's yellow. And we've got Standard Chartered, which is a GSIB bucket 1 bank. But that's it. If your bank isn't in that list, then it's not a GSIB. That doesn't mean it's extremely risky. It just means that it's probably having to pass less stringent tests in order to ensure it's safe. So what we've seen in this crisis is money flowing from regional banks, say, in the United States, to the GSIB banks because they're just seen as being safer with much more fortress-type balance sheets. So if bank failure is a really big concern for you, then maybe you should consider moving your money, or at least some of it, to one of these GSIBs. Now, what went wrong in the previous banking crisis in 2008 was banks not having enough loss-absorbing capital. So what does that mean? So here's a sketch of a bank balance sheet. This time we've just got debt and we've got equity. We don't have deposits. Think of the deposits like a form of debt. But the reason why I've shown this is to show what happens if the value of your asset suddenly goes down. Why would that happen? Well, let's imagine that house prices crash. That would mean that more homes are going to get repossessed and a lot of the mortgages on the asset side of the balance sheet are going to go bad. The bank's just not going to get its money back. That means that the value of the asset has to be written down by a lot. Now remember that the balance sheet has to balance. The assets go down, so the liabilities have to go down. Which part of the balance sheet shrinks on the liability side to absorb those losses? It's the equity. So let's see what happens to the balance sheet. The assets shrink, but so did the liabilities. But notice that the debt didn't shrink. Let me just step back and forth so you can see that. The size of the debt remains exactly the same because the bank still owes money to its creditors. If the losses on the assets gets even bigger, the equity will shrink even more. Now, if the size of the equity on the liability side shrinks to zero, the bank is bankrupt. So that's why the amount of loss-absorbing equity on the balance sheet is absolutely critical for risk management. If the value of the assets is very volatile, that means that they're likely to lose a lot of value over a short period of time, then you better have lots of equity to absorb those losses. And in 2006, banks didn't, and that's why Lehman failed, for example. So regulators came up with the idea of a capital ratio, a single number that would capture how much loss-absorbing stuff a bank has on the liability side of its balance sheet. It's simply the amount of loss-absorbing stuff, primarily equity capital, divided by the amount of risky stuff which the bank owns. What does that look like in practice? Well, we use something called a CET1 ratio. That's a Common Equity Tier 1 ratio. What's Common Equity Tier 1 capital? Well, primarily it's things like common equity. That's the amount of capital which has been raised through issuing shares, but also retained earnings. If a company doesn't spend its income, then actually that can bolster its CET1 ratio. But of course it's dead money. It doesn't generate a big income for the bank. So the drawback of having a high CET1 ratio is that the bank becomes less profitable. So banks don't like it, but regulators do. Then the denominator is also interesting because it's not just the amount of assets. You could just take the size of the whole balance sheet, but that's not what regulators do. Certain assets have a bigger risk weight, and some of them have a zero risk weight. So for example, a treasury isn't considered risky at all, even though Silicon Valley Bank essentially failed because of its loss on its treasuries. But things like risky loans, mortgages, those have a pretty high risk weight because they're volatile, and if they lose value, then the bank could become bankrupt. So it's certainly worthwhile looking at these CET1 ratios, but regulators are keeping a very close eye on them anyway. So for example, here are the Common Equity Tier 1 ratios for UK banks at the end of 2022, and they're all within a pretty close band of one another. The lowest is Barclays at 13.9%, and the highest is at NatWest Group, but that's only very slightly higher at 14.2%. What is interesting though is that the ones with a lower CET1 ratio are the ones which have sold off the most in this crisis. It's not an exact correlation, but it is quite noticeable. So if you are really worried about losses on the asset side of the balance sheet, then you go for a bank which has a high Common Equity Tier 1 ratio. And again, if you want to find that, just Google annual results Barclays 2022 and then just look for the word CET1. It's usually in the first paragraph. Another thing which is really important but very difficult to quantify is reputation. Another failure that we've had recently was Credit Suisse, which was acquired by UBS. Now what's interesting about this was that there wasn't a problem with the Common Equity Tier 1 ratio for Credit Suisse. It was actually pretty good. The problem was its reputation. Now, just before that takeover happened, Credit Suisse was at pains to point out that its Tier 1 ratio was actually very healthy. Here it is compared to many other banks, and it's considerably higher than other banks in this list. But that wasn't the problem. Credit Suisse had been embroiled in many scandals. In fact, since 1986, it's been very accident-prone. Just in 2021, there were 3 crises, one with Archegos Capital, that was the hedge fund which collapsed. Credit Suisse was involved in that and had a loss during that debacle. Then we had the Greensill scandal, and we had the Mozambique tuna bonds. Now all of this results in losses for the bank, financial losses because of lawsuits, but it's also a reputational risk. So another thing to consider when you look at your deposit at your bank is how many scandals has your bank been involved in? What's its cultural risk attitude? Some banks have a very cavalier attitude to risk culturally, and that's a massive problem, particularly when depositors are nervous, because all it takes is one scandal combined with social media to bring a bank down as people pull out their money simultaneously. No bank can survive a bank run. Remember that. Another crude but effective signal comes from the share price of the bank itself. So here are the UK bank stock returns for this crisis period. This is the 1 month period ending on March the 20th. Notice how Barclays has sold off by over 20%, whereas NatWest Group sold off by only 9%. As I said, some of that is because of the common equity tier 1 ratio. That's higher for NatWest than it is for Barclays. HSBC also sold off by less, probably because it's a GSIB. But what some people assume is that everything is baked into the share price. That's not completely true, but it's certainly partially true. So if the share price has gone down a lot, it's maybe because someone knows something. So if you see your bank's share price plummet more than others, then that should be cause for concern, or at least the starting point for research into why it's happened. In conclusion then, one way to reduce your risk of losing capital if your bank goes down is to spread out your money between different banks, being careful about those parent entities, such that all of your capital is under the deposit guarantee. That's an obvious thing to do. It's a pain because you have to remember multiple passwords, but during a crisis like this, it might be worthwhile. A second thing to consider is whether your bank is a GSIB, or at least a large bank, because those are probably the safest ones. They have to have the most regulatory capital, that's the amount of equity on their balance sheet, but also they have to pass very stringent stress tests. Plus, a lot of the capital is going to be heading for those banks anyway, and out of the smaller banks and the regional banks. So having at least some of your money with a GSIB isn't a bad idea. And then finally, try to avoid scandal-prone banks. Deposit flight is much more likely if a bank is risky and perceived to be risky by its depositors. In the age of social media, you just can't afford to take a risk with a bank like that. So I hope it's clear from that no bank is safe. They're designed to fail. All of them take balance sheet risk. If the value of their assets falls more than a certain amount, it'll wipe out their equity and they'll fail. If they have lots of deposits lost due to a bank run, then again, they'll fail. The best you can hope for is to use that deposit guarantee in your country to ensure that you're below that limit and your money's safe. Now, don't forget our offer from Babbel. It's a great way to learn about language, and you'll find more about that in the description. Beneath me, there'll be a link. And, as always, thank you for listening.